Ladies and gentlemen, good day and welcome to Senco Gold Limited Q1FY26 earnings conference call hosted by Anand Rathi Shares and Stock Brokers Limited. As a reminder, all participants' lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vaishnavi Mandhania from Anand Rathi Shares and Stock Brokers Limited. Thank you, and over to you, ma'am.
Thank you. Good morning, everyone. On behalf of Anand Rathi Shares and Stock Brokers, it's our pleasure to host the Q1FY26 earnings conference call for Senco Gold. From the management side today, we have Mr. Suvankar Sen, MD and CEO, and Mr. Sanjay Banka, the CFO. I now hand over the call to the management for their opening remarks, followed by a Q&A session. Thank you.
Thank you very much. Good morning, all my dear esteemed investors. Today, myself, Mr. Banka, and many of our team members, namely Mr. Dhaval Raja, who is heading our sales, we are all joining for the conference call with all of you. Just to kind of update you that today I am joining from my home because I'm under the weather. So my team is in the office, I'm at the home, so there could be some coordination delays or any kind of thing. So kindly take note of it and we shall, otherwise continue with the call. The good part is that as we begin this financial year and we look at the results and the numbers of Q1, on behalf of Senco Gold Diamonds, we are extremely happy and extremely delighted to inform that overall the performance of the company in terms of top line, in terms of bottom line, has been extremely robust and very, very encouraging. If we look at the particular quarter before we get into the numbers, and we look at the overall macroeconomic scenario, we are all aware that this quarter, while there was the Akshaya Tritiya and Paila Baishakh and New Year's in many, many states, which gave a very strong platform as an auspicious season for the consumers to come and buy. At the same time, there are macroeconomic geopolitical tensions that we continue to see, and that has led to the increase of gold prices about 5% quarter on quarter and about 30% compared to the previous year's similar quarter. But in spite of the increase in gold prices, we have seen that the consumers have continued to come and buy and purchase jewelry. In terms of the growth that we have seen, that the revenue has been up for the retail side of upward of 28%, and the same-store sales growth, which is a very good indicator of the loyalty of the consumer, of the commitment and the effort that the teams are putting, has been upward of 19%. And overall, if we look at the bottom line, the profitability, we have seen last year's quarter to this year's quarter profit PAT growth of upward of 100%, where we crossed 100 crore PAT for this particular quarter. And this reason of a very good PAT that we could achieve has been led by 2 to 3 reasons. We have seen that in terms of the diamond jewelry sales, there has been a very strong demand, and we have had a 35% year-on-year growth in terms of volume and above 50% in terms of value. Now, there could be a lot of thought processes. We have all been hearing for the past financial year that, the diamond prices have been on a downward trend and consumers are losing their faith and trust on diamonds. So that was the situation that we had seen in the previous financial year. But if we look at it and see what we are seeing in Q4 of the previous financial year and Q1 of this year, that with the gold prices going up so high, there has been a tendency of the consumers to buy diamond jewelry for their everyday wear basis or for their special occasions. So our stud ratio, which was on an average of 9 to 9.5% in the previous financial year, has moved up, crossing 11% for this particular financial year Q1 with such a high growth, and that has been one of the major reasons why we could see that there has been a positive impact towards, the profitability. At the same time, we have also seen that there were certain uncertainties in terms of the gold metal loan interest that the banks were charging, and due to certain of the tariffs and certain of the policies that Mr. Trump was putting or the US had towards the gold loan, there was a short-term impact of increase in interest rates on the metal gold loan. And as a proactive measure, what we had done is that in order to mitigate that high gold price, we were trying to mitigate it with increasing the making charges in certain categories so that those higher costs could be passed on. And I think that those timely actions that we have taken by protecting our bottom line and by being extremely efficient with our planning has helped us in order to ensure that we can cover the costs. And we have seen over a period of time that those interest rates that were increased at that point of time has gradually over a period of time come down. So, that has been one of the major part where we could continue enjoying the benefit of those little higher interest rates. Because at what we have seen is that this whole season, because of the high gold rate, we had to continue to give discounts, to give offers, whether it be for Akshaya Tritiya, whether it be for, Rath Yatra, which was in the month of June, or the necklace festival that we did. But, because of those management of the making charges, I think that there was a lot of intelligent action that we had taken that could help us in increasing our profitability. Also, one thing that we have done for this particular quarter is that usually we have been last financial year maintaining a hedging ratio of about 75 to 80%. In this particular quarter, in order to maintain the liquidity, in order to maintain that, yes, we could continue to focus on our business and not get impacted with the increase in gold price, giving a higher amount of money towards margin, we had kept our hedging ratios about 55 to 60%. And I think that that has also worked in favor of the company and helped us to ensure that the liquidity continued to remain strong and the profitability also continued to remain strong. And one very important thing is the focus on efficiency. For the last 6 to 8 months, we have appointed a particular consultant and a tool and a software on which we are continuously working on driving efficiency at the store level. Exactly which stock, which design, which is what is moving at what store, and especially so more because with the increase in gold prices, we are seeing that the average ticket size and the weight range that we are selling to the consumer has been on a downward trend. The ability of the consumer to buy jewelry of higher quantity is getting impacted. And we are proactively looking at the weight ranges that are getting sold and accordingly fulfilling those kind of designs and products at the store level. And I think that has also worked in our favor on the efficient planning and has led to a higher increase in terms of the margins. Now, what we could see in terms of certain good achievements for this particular quarter is that our focus on designing has continued to remain very strong. We have created more than 11,000 designs for this particular quarter, and I think that our design team, our merchandising team are continuously working towards it. We are very much conscious that with this high gold price, 18 karat, 14 karat, 9 karat, these are the future, and we need to focus, whether be it in diamond jewelry or plain gold jewelry, so that we can continue to have the younger generation coming and buying from Senco, or people who have a lower ticket size can come and buy from our brand, because we have always stood for design and we have stood for creating jewellery that could be afforded and bought by everyone and anyone, and we will continue to with that pursuit and focusing on the same. And in terms of the bridal, which is some kind of a purchase, no matter what the gold price is, consumers will buy. So we had launched our Khushiyon Ki Reet, the legacy tradition and the legacy collection, focusing on an ad campaign that the grandmother, the mother, and the daughter, or rather the granddaughter, is buying the jewelry from Senco, which we stand for. And I think that has, kind of connected with the hearts of the consumer, and they have continued to stay and buy for the wedding also. One very important thing that we have seen is the old gold exchange, which has become 40% of the total transaction that we are doing. So the fact that, we are conscious that people might be having lesser liquidity and lesser ability to spend money on cash, We have seen that the old gold exchange was about 25% of the overall business, maybe 2 to 3 years back. But that has become almost 40% of the overall transaction that we are doing and is helping the consumer to keep on coming back to the stores. This particular quarter, we have been able to open 10 stores, including one Senes store. And I think that our overall aim for the financial year is to open 20 stores. We are very much, in the journey of opening 20 stores. And our hope is that we might open 1 or 2 more stores more than 20, but surely our expected numbers of 18 to 20 stores will be achieved. If we look at the overall guidance in terms of the numbers that we want to achieve over the period of full year, in spite of the fact that, yes, this particular quarter we have grown by more than 30%, but as a guidance, we will continue to guide all of you that, yes, 18 to 20% growth for the whole financial year shall continue to remain as we cross quarter 2, move on to quarter 3, have the Dhanteras season, experience it and how consumers are behaving on it. We will be in a better position to up our guidance. But for now, I think that we should all aim for looking at a guided number of a 20% growth. At the same time, if we look at the EBITDA numbers, Mr. Banka shall further on, explain to you with all the details. But I think that we had initially guided about 6.8 to 7.2% EBITDA for the whole year. This particular quarter, we have been able to perform and achieve very good numbers. But I think that 7% EBITDA should be a conservative way of looking at the full year's guidance. And as we progress with the year, we will keep on updating you. And before I kind of give my closing remarks, what we want to tell you is that this particular quarter 2, if we look back to the previous years, particular this quarter, we had experienced the duty cut by the government on gold, and that had led to a kind of a robust sales in the month of end of July and August. This year, we do not have such an incident of any kind of duty cut unless we see the gold prices coming down. So I think that, the growth compared to last Q2, this particular Q2 will again remain in the range of 18 to 20%, maybe 16 to 18% as on date if you look at it. And, going forward, we are all planning for the Q3. We have the Durga Puja, the festivities starting from September. So everything has come ahead. Currently, as we speak, we just finished off with Rakhi, and then now the Independence Day offers and collection of chains have been launched for this particular Independence Day offer period. And I think the focus on the new collection for the bridals, for the men's jewelry, for Everlite everyday wear. Also, we have seen that the silver and fashion jewelry has also had a lot of traction and has growth of upwards of 50-60%. So in this high gold price, I think that gifting for your loved and near and dear ones, fashion, these will all become very, very critical, and all aspects of the business has to be looked at. And obviously, in order to ensure that the profitability remains, diamond jewelry will continue to remain our focus. And we are coming up with new collections in the field of diamond, whether be it necklace or small items. And with that full planning, this quarter 2 will be more towards gearing up for planning, for customer relationship building, and for the fact that we all get ourselves fully prepared for the festive season that is coming up in the first part of quarter 3. So with this, we would like to sincerely extend our gratitude to all of you, for being a part of our team, for being a well-wisher, and gratitude to the whole team of Senco for giving their hard work and effort for the wonderful achievement and the wonderful numbers of quarter 1 for financial year 25-26. Thank you very, very much.
Yes, sir. Thank you. So, building on what our MD has said, there are a few incremental points. One is that you have seen that the growth has been quite satisfactory. YOY 30% growth on top line, and EBITDA has grown by 68.8%. EBIT has grown by 78.3%, and PAT has grown by 104%. So while and similarly, the EBITDA margin has grown from 7.7% to 10.1% YOY. But if you look at quarter 4, it has moved from 9.2% to 10.1%. Similarly, the EBIT margin, while YOY have moved up from 7.3% to 10.1%, but on Q-on-Q, it has moved from 8.9 to 10.1, and PAT has come in the range of 5.7%. So while these are the qualitative factors, but as we have guided that on a sustainable basis, we are looking at 6.8 to 7.3. It can be 7.3 or 7.4. But so we should see these numbers with a particular quarter perspective. I'm also happy to announce you that in the month of April, we achieved a top line of almost 1,000 crore. And in the entire history of last 5 years, only last year, October, was around 1,100 crore. So this superior achievement is clearly reflected due to our consistent focus on hyper-local jewelry, the new stores we have launched, and the pan-India story. That is point one. Secondly, it's important to understand that, as you've said earlier, we don't sell any bullion. In our case, it's only coin sales. So coin sale out of the total sale is only around 5%. That's why we don't see any dilution in our gross margin. If we look at other factors, so within the growth, if we look at the growth prism, the value growth in diamond is around 54%, and volume growth is 36%. So we are seeing a consistent momentum in the diamond sale, and I also understand that a few mines have closed abroad. 2 to 3 mines have closed, and the prices are likely to increase. So this is going to be a major tailwind for increasing the prices. And when the prices will increase, you will see an improved realization. What you've seen, which is getting reflected in our superior gross margin for this quarter, which is partly ascribed to the making charge increase, the better realization and pricing on the diamond, and a certain impact of higher gold price. And we've also stated that our growth, which has come from own store and franchisee store, the growth from both are slightly different. But overall, we are looking at this growth, and we are confident that we'll achieve around 20 to 21% growth. We are also happy to announce that ICRA has confirmed our credit rating for short-term working capital requirement at ICRA A2+. Similarly, our investment in inventory is consistently increasing. If you look at the balance sheet numbers which we have published, it has increased to around 3,558 crores, as against 3,300 crore in March 25 and 2,457 crore in March 24. So from 2,457 in March 24, within this 15 months, it has increased almost by 40 to 50%. So this clearly shows that we have a commitment to growth. We have adequate working capital available with us, and we will continue to grow in the range which you guided. So with that, I close my remarks, and thank you all, and then we can start the Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mihir Shah from Nomura. Please go ahead.
Hi, sir. Thank you for taking my question. Congrats on a good set of numbers. So I wanted to check on how should one think about the impact of revenue if contribution of lightweight jewelry goes up. Can it impact the overall revenue growth as value of gold will be much lower for 9 carat, 14 and 18 carat? What percentage of sales are now coming from lightweight for you? Also, a follow-up is if you can also share are margins in your lightweight jewelry very different from your 22 carat and 18 carat? So that's my first question.
So thank you, Mihir. Mr. Bhaskar, am I audible? Yes?
Yes, sir, you are audible.
Okay. There's a little echo happening, but what I want to, to answer to the question, maybe I'll give a few, to just give a guidance and you all can support with the data that, our average ticket size overall, whether it be the, lightweight or heavyweight jewelry all put together is in the range of 70 to 72,000. And the good part for us and our product that we are selling to our consumer base is 60 to 70% of the products are below, I would say, 7-8 grams. So with an average ticket size of 50,000-60,000 rupees. So it is not really the lower purity of products that there becomes a risk of the ticket sizes going down because, there is a range of 10 to 20,000 rupees products, which is of the lower ticket size of 9 carat and 14 carat, which is in demand for the young generation consumer. But in general, even if we look at a housewife who is across the age of 30, 35, 40, and we look at her purchasing power and the ticket sizes that she would be looking at, it would be in the range of 40 to 55, 60,000 for in the form of a earring or a pendant or a chain. And it is only that the form or the design of the product is changing for the purpose of fitting into the budget of the consumer. But just by making it 9, 14 carat or 18 carat, I do not see it as a big risk that the overall ticket sizes will come down because consumers' budget over a period of time, because the gold prices have gone up by almost 30% year on year, the consumer budget can get adjusted by maybe 8 to 10%. Depending on the growth of the economy, the income levels of the consumer growing, and we are all confident of the India growth story. So yes, over a period of time, the consumer shall have her increased budget, and the budget, even with lower ticket size in terms of weight, has gone up over the past year. So just to allay your concern that I do not see much of a risk, rather it is only going to be a solution that we will provide to the consumer by providing jewellery, as most of it Western and modern design, in 9 carat, 14 carat or 18 carat. And when it comes to bridal shopping, where the consumers, irrespective of whether it's 22 carat or 18 carat, people go for a higher ticket size item, where it can be above 1.5, 2 lakhs, 3 lakhs, upwards 4, 5, 6, 7, it goes on like that. So there I think the ability of the consumer for a wedding is that yes, a part of it will be given with their old gold, a part of it will be given with their, whatever, cash, credit card and all of that. So we'll see a 10-15% downward trend in terms of volume for that kind of bridal jewelry. But there again, 22 carat, 18 carat will be the main focus area. So that's how it is. I do not see that much of impact happening on the overall volume. We need to increase the number of consumers also as a part of the growth story with opening of new stores or even the same store sales growth of 19%. So even if the stores can gain maturity, we are encouraging the stores to acquire newer and newer consumers. That is one. And in terms of the margin, I think that if it is plain gold jewelry, whether it's 14 or 18 carat, it is of a smaller quantity, so there is not much impact in margin. But what we have seen is that most of the 14 carat jewelry or 18 or 9 carat is studded with either diamonds or other stones, and just the way diamonds jewelry has a higher margin, so this 14 carat or 18 carat jewelry will have marginally higher margins than a plain gold jewelry. So this is to answer to your question. Mr. Banka, Dhaval, if anything you want to add, please.
As sir has explained, if you look at our ASP has moved up from 48,000 rupees to around 52,000 rupees. So ASP has increased by almost 12%. And while the gold prices have increased 30% YOY and 5% QOQ, customer has to make purchases. So he slightly moves up his wallet size, and balance he looks at either reducing the type of jewelry or goes to lower carats. Similarly, ATV has also moved up from 73,000 to 79,400. Your question was, what is the lightweight jewelry? So this amount itself is lightweight jewelry, 52,000 or 79,000. Now this This is a blended ASP for gold, diamond, platinum, and silver. So if you look at ASP of silver, that is around 2,800. So if you look at ASP of gold, if I give you a ballpark number, around 61% of jewelry in terms of count are in the range of 25,000 rupees. So 61% of jewelry, 25,000, that is a key strength. And similar would be number in the diamond jewelry as well. While in terms of value, we can take a number of 33. But in terms of quantity, this 61% is around 25,000. That is our key strength on which we have built a strong moat around our business. I hope that answers your query. Dhaval, you want to add something?
Yes. See, on an average, our ASP itself is 55,000. So we are enjoying that dominance in the lighter space, So average selling 6 odd grams itself is a lightweight jewelry. So, introduction of 9 carat or 14 carat or 18 carat will further, add to the overall buying pattern of the consumers. But right now, per se, the business that we are driving is, driving through the lightweight jewelry that we have. Thank you.
Understood. Thanks, gents. That clarifies. Secondly, I wanted to check if...
Sorry to interrupt. We have several participants waiting. We request you to please come back in the queue for a follow-up. Thank you. The next question is from the line of Devanshu Bansal from Emkay Global. Please go ahead.
Hi, sir. Good morning. Thanks for taking my question. Congratulations on good set of numbers, and Suvankar, wish you a fast recovery. Suvankar, definitely we are seeing that franchisee interest is definitely picking up with 6 editions already in FY26 till date. How is the pipeline looking for you for the rest of the year, and can we expect higher than say 20 editions that we have planned, and that too with a higher mix of franchisees for the current year?
So thank you, Devanshu, for your wishes. See, our plan as we began the year was 20 stores, 10 own stores and 10 franchisee. While internally our effort and plan is that we should try to open more franchisee rather than your own stores, to have a better performance overall. So we have already opened 5 franchisee stores, and I can tell you that we have more than 5 franchisees in the pipeline. So hopefully instead of 10, we shall be able to open maybe 11 or 12 franchisee. And so that is how it is. So 20 stores is something that we will keep guiding you right now. And maybe after end of quarter 3, we can update you more further on it. But our efforts are towards opening more and more franchises.
Understood. And Suvankar, any specific initiative that we have taken which is helping us gain more franchisees in the non-West Bengal region? So earlier we were very skewed in terms of West Bengal, but now we are seeing evidences of franchisees in Maharashtra, UP, Bihar. So any initiatives that we have taken which are helping us here?
So I think that it's more of a brand awareness that is very, very critical. So our investment into marketing, brand building continues to remain. Our brand ambassadors, most of them have they are national celebrities. So I think that the visibility is growing up, awareness is growing up. Along with that, our team, there is a dedicated team who are connecting with the potential franchisees. And I think that, for the industry per se, it's not just us, but all our fellow jewelers who are in this particular business, it is an opportunity. We have all seen that gold is a good asset to invest for any kind of investor, along with real estate and other investments. So it is all about building the brand and building the relationship. And then, there are potential franchisees who are willing to open a store of Senco. Plus, what is very important is that, our manufacturing strength and ability, being from the geographic zone that we are, gives us that flexibility. And I think that, we are there in the business of franchisee for more than 20 years. And with all our experience, we are giving our best to keep on connecting with the franchisee. So that is what we feel is from our side. Thank you.
Understood. And so studded growth has picked up significantly. This is almost at 35% growth in Q1 versus last year we did about 5% odd growth. And when compared with larger peers also, there the studded growth is only 10-11%, right? So what is sort of helping us here, because this is segment where our presence was very low. How are we sort of trying to differentiate ourselves in some
So I think that, two things majorly. One is that designing where, if you look at our numbers, we have done more than 11,000 designs overall, gold and diamond put together. So a lot of design development under our Everlite collection is happening. And also in terms of our pricing, though we don't want to get into any kind of price competition with others, but overall I think that we being able to manage our costs better and giving a competitive rates to our customers. And there is a continuous effort by the team in terms of offerings, in terms of schemes. And I think when the consumer is coming to the store and looking at it, and especially with the gold prices going up, so if you want to buy a 40,000 rupees worth of gold jewelry and what you are getting with diamond jewelry, the design attraction is much better. So we are being able to convert it in a much easier manner. So I think all put together, this is where we are getting the results. And last financial year, sometimes the overall situation is such that even with your best efforts, you might not get the results, right? So last financial year, when the gold price was moving up from 60,000 to 70 to 80, even when we were offering diamond jewelry to the consumer, they were not in a mood to buy. They were like, no, we will buy gold jewelry only. But what we have seen from the last Q4 of last year and this year is that the consumer is open to try and convert themselves from gold to diamond jewelry. And I think our efforts and consumer requirements both are helping in the growth of diamond jewelry.
I don't know, sir. That was very encouraging. Thanks for taking my questions.
Thank you.
Thank you.
Participants are requested to restrict their question to 2 per participant and come back in the queue for a follow-up. Thank you. The next question is from the line of Vidisha Seth from Ambit Capital. Please go ahead.
Yes. Hi. Thanks. My first question was on the margins. You talked about the 3 to 4 levers which drove 230 basis points of margin expansion. If you can help us out as to which of breakdown which lever contributed to what percentage of the margin expansion and how much of it is sustainable going forward.
Vidisha, as we have said earlier, we have talked about a sustainable margin of 6.8 to 7.3. So which MD sir said that it can be in the range of above 7%. So on an extremely aggressive side, we can take from 7.2 to 7.5, but that is on a higher side. So sustainable EBITDA margin, we are looking it in a range bound manner only, not what has come in quarter one. So now the question is what margin is a very complex result of multiple efforts which have been taken from time to time. Okay, but if I try to pinpoint it to 2 or 3 reasons, one is the making charges. We had increased our making charges due to the expected GML price rise. And while the GML price is coming back to original level, we have not reduced our making charge. And you are saying that with the brand positioning, we are able to charge a better pricing. So that is one. I'm not putting a number to it. Similarly, diamond price, since we had built our inventory base of diamond when the prices were lower last year, and as we told that some diamond prices are moving up, and some mines have closed and customers are coming back to the natural diamond. So we are able to realize better prices for diamond. And third is what we already said is about hedging. While we are doing the daily hedging regularly and hedging in the range of 65 to 67% on an average. So due to lesser hedging also, we've been able to realize the gain on the gold price effectively. So these 3 are the major reasons which we can say have contributed to the higher gross margin and the resultant higher EBITDA margin in quarter one.
So the hedging ratio would remain at 60, or how should we think about hedging ratio going forward? While board policy, we understand it's more than.
Hedging is a very dynamic thing, no? It will depend upon the risk scenario, the global geopolitics, how the entire demand supply thing is happening. But we are committed to maintain a very robust and a dynamic risk management policy. We are cognizant that we can't. It has to be very dynamic and a robust hedging policy, but it will always be above 50%. That is the board norm, and on a daily basis, we are almost doing 100% hedging. At an inventory level, since our inventory is only for 6 months, so that's why 6 months inventory, 50% for 3 months, volatility around. So it will be in the range of 50% to 80%, depending upon the risk perception.
Okay. And the second question was on the competitive landscape. How do you see that evolving, and how does it impact industry making charges going forward? Will it further come down, or what are your thoughts on the competitive landscape, please?
So I think that when it comes to competition, I do not see that making charges would be going down much further. Yes, based on the situation, there could be continuous offerings and special incentives and special schemes. But I think that we have reached almost the kind of the best possible situation of competition. I think it's better now. I think all the jewellery industry players are looking at focusing on design, focusing on brand building, focusing on any kind of innovation in the market rather than just play on the part of pricing. I think that's how we are looking at it.
That's helpful. Thank you. All the best.
Thank you. The next question is from the line of Akasha Shah from Samiksha Capital. Please go ahead.
Hello, sir. Thank you for providing this opportunity. I would like to ask you, in your gross margins, what is the share of gains due to higher gold price? That is my first question. And my second question is what is the value of inventory as on June 30th?
See, June 30 inventory is, we have given the balance sheet as well. The June 30 inventory 3558 crores as against March 25. So March 25 was 3,299 crores, which has increased to 3,558 crores. This inventory clearly includes the gold, diamond, platinum, silver, etc. So let's say diamond should be around 450 crore, 100 crores should be silver, platinum, stones. Balance is all gold. The inventory is the number is the cost or net realizable value. There was some newspaper report also so I am taking this opportunity to voluntarily clarify that we have been following weighted average cost method for almost 10-15 years. So the inventory reported is a weighted average cost and cost or net realizable value duly audited consistently. That is one. Your second question was, so this inventory, you have to look it from the inventory turn perspective. So let's say, as you said, on a whole year, the total sale will be around 6,500 kg to 7,000 kg, depending upon how the prices span out. That means in one quarter, it will be around 1,500 kg or 1,600 kg. So 2-quarter inventory will be around 3,000 kg. Those are the broad numbers. Your other question was how much is the impact of lower hedging. See, it's very complex process of hedging. I would suggest that you look at the document which we published in Q3 regarding the hedge accounting impact of fair value hedge and cash flow hedge. But broadly, as I explained earlier, it should be around 100 or 120 basis points impact, which has flowed into the gross margin. But it is purely temporary for Q1. We are not saying that it will happen every quarter. If the volatility increases tremendously, we will go back to the 80% level of hedging immediately, and then these gains will not flow. That's why we are saying 6.8 to 7.3 as a sustainable level of EBITDA margin.
Okay, sir. Got it. Thanks a lot.
Thank you. The next question is from the line of Bhavya Gandhi from Dalal and Barocha Stock Broking Limited. Please go ahead.
Yeah, hi. Thanks for the opportunity. Couple of questions. My first question is regarding hedging only. Sir, at what point do we decide to increase? So, I mean, if the price fall is more than 10%, we decide to increase that hedging by 10%. Is there some metrics that we internally look at? If you can throw some light on that. That is my first question.
See, Bhavya, as you said that we have a very robust risk management policy and we have a risk committee of board of directors. Continuously reviews with the various risk.
Sorry to interrupt. We would request Bhavya sir to please mute your lines while the management is answering, as there is a lot of background noise.
Yeah, thank you. So, Bhavya, we have a very robust risk management policy and framework in our company, and we take advice and guidance from international experts on hedging as well. Then we have an internal treasury committee. So, based upon the entire framework, the company is committed to maintain a robust risk management framework. That's all I can say. So, the level of hedging, the percentage of hedging is very dynamic. It is also subject to the working capital availability at a particular moment of time. But the board policy clearly says minimum 50% hedging, and we've always said that hedging will be between 50% to 80%. Last year, at many times, it was up to 88, 89%, and even 100% as well.
Fair enough. Sir, another question is regarding, is there any arithmetic correlation between stud ratio? If suppose 1% increase in the stud ratio, what impact will it have on the EBITDA margins? If you can throw some light on that as well.
So there is no direct correlation. Yeah. So what we've said is that we want to take the stud ratio to 15%. But if the ratio slightly increases to, let's say, 1 more %, I think 30-40 basis points improvement will happen in the EBITDA margin. But then once again, as we grow, we'll have other pressures as well. But I don't think that we can take more than 20-30 basis point increase in the EBITDA margin based on the higher stud ratio.
Got it. And is it possible to say the secondary sales number for the quarter and the base year as well?
Secondary sale, you are saying at the franchisee level. So what we are reporting, the total growth is at the primary level, which we have reported at 30% YOY and 32% quarter on quarter. And so what we said is that the own store growth was 25% and franchisee growth was 34%. We've also said that the SSG was own store 21%, franchisee 16%, blended 19%. So the primary sale, the secondary sale would be around 85% of the primary sale. I think that is the ballpark which I can give. And just give me 1 minute time if I can trace them. Around 85% will be the secondary sale. So let's say the franchisee growth, which is 34%. Secondary is 24%. So the secondary growth, while the primary growth in the franchisee sale is 34%, secondary is 24%, which effectively is same, around, which I said 80-85%.
In new stores, primary is more.
Yeah. So what Dhaval is clarifying that since, and you will see this phenomena in other peers as well. So if you open more franchisee, obviously your primary will be high. So let's say this year we've already opened 5 franchisee. So to that extent, the primary is more.
So we have a primary of 34% in the franchisee channel in Q1, which is a growth, and we opened 5 new stores. So by virtue of opening new stores, we have a more primary, whereas the secondary growth in the franchisee channel stands to 24%.
Fair enough. That is really helpful. I'll get Yeah, sir. You're clear. I'll get back in the queue, sir. Thank you so much. Yeah.
Thank you. The next question is from the line of Rupesh Tatia from Shri Ram Managers. Please go ahead.
Hello, sir. Thank you. Thank you for the opportunity. Before starting my question, I have one clarification on the opening remarks. Did you say that for Q2 to Q2 last year to Q2 this year, we can still expect 16 to 18% growth despite deferment of demand to Q2 from Q1 to Q2 last year because of duty impact? Did I hear that right?
You're right. So
Okay, that's good. So my first question or sort of observation, Suvankar, is I mean, you are in the business of providing solution to your customers. You are doing so many designs. You're coming up with so many formats. This quarter, if I heard right, you were able to increase your making charges. So you're in the jewellery business. Why play around with this hedging and try to gain from commodity movements? I think my humble submission is that you should review your hedging policies and get them closer to the market leaders. You should probably study Titan or Kalyan or maybe some other global brands, and you should get it closer to that. You are in the business of selling aspiration. You do that. Don't do commodity hedging and try to gain out of it. So this is my humble submission to you.
thank you. No, I totally take your submission, but sometimes what is happening is that the liquidity constraints that we get, because when you are taking hedging, there are two parts to it, right? One is 100% hedging, as whatever you're selling, you're buying. So that is something that is anyway automatically 100%. But when it comes to taking a sell side on NCX, or when there is a gold loan that you take from the bank and the prices are on the upward trend, then because of the liquidity constraint, you are unable to hold on to your position, and then you think of reducing it from an 80% to a 60%. And it is not about gaining profit, but it is about protecting liquidity also. Like last 2 years, it is a fact that almost 100 odd crores, while the profits have come, everything has gone. But because of hedging, 100 crores of liquidity also kind of got out of the system. So this time we are also trying to maintain the liquidity along with the business growth and profitability. But we totally take your point, and whenever we are not in the business of kind of speculating and making money out of it. So let me assure you on that part, and we will keep your advice in mind.
Okay, thank you. The second question, sir, is how is Q3 looking from festive season, from wedding dates? I know it's maybe a little bit too early to talk about it, but seasonally Q3 is strong. How is the preparation? What is the expectation in the market? Then there is this tax cut. I think benefit will start flowing into hands of consumers. So any early outlook if you can give on Q3?
No, so if you ask from a outlook perspective, I think we are being very positive in terms of our planning, in terms of our ensuring that the right inventory comes at the store before the Diwali Dhanteras season, festive season starts. All the plans are in place, and what we have seen is that in Q1 or even in Q2, compared to other years, this time the number of wedding dates have been lesser, and most of the wedding dates now that will come majorly will be in Q3 and Q4. And if I'm talking to my consumers also, I think that everyone is in a mood that the moment either liquidity comes in their hands or they feel that the gold price is the right price to buy, I think the wedding demand will come in a big way. So yes, Q2 will be a little, not so, I would say, robust because of lack of auspicious season. But yes, it is more of the beginning of the auspicious season. And Q3 will be a very good Q3. So we should be all ready for the season to become strong any moment.
Okay. And then quickly, I'll squeeze in one last one. What was our LGD revenue in this quarter, and any guidance on LGD revenue for FY26?
LGD revenue has been very, it has been in the, I would say, single digit, low double digit, the single digit. So LGD is still in the phase of, we have 6 to 7 stores. We are not selling LGD to all our stores. We are creating a separate brand. Consumers are building up the awareness, and we are very clear that when it comes to the weddings, people are not, buying LGD. It is more from a fashion perspective. But when it comes to weddings or such occasions where emotions are strongly attached and it's once in a lifetime, people are preferring the natural diamonds. When it comes to fashion or some kind of impulse purchase, people are going for LGD. So that is how it is. So over a period of time, maybe in 4-5 years, LGD will keep picking up more. But till now, it is still natural diamonds that is holding the fort.
But will it cross, let's say, 50 crore in FY26?
FY26, I do not see it from our side crossing. I do not see.
Okay. I have more questions. I'll come back in the queue. Yeah.
Thank you. The next question is from the line of Akash Jha from AJ Wealth. Please go ahead.
Hi, sir. Congrats for a great set of numbers. So, first of all, I want to understand early consumer response to our 9-carat jewelry, and as well as the margin per gram compared to 14-carat and 18-carat.
So the consumer response have been, I would say, positive, because the 9-carat jewelry is coming to around 3,500 to 3,800 rupees per gram. And if it is like a 1-2 gram lightweight everyday wear, then if the budget is anything below 10,000 or below 15,000, it is allowing the consumer to kind of buy it within the budget. And we are also taking, I would say, measured steps. It is not like we can convert all our inventory into 9-carat, and especially it is in the studded sector. It will not be much in the traditional designs that people will buy 9-carat. It will be in the modern Western design that people will buy 9-carat. So in diamond jewelry and in lightweight gold jewelry, we are introducing selected collections and testing the markets. But consumers are being positive. And I must say that it is the young consumers who are more open to the idea that in terms of buying 9-carat. And I think that once the wedding season will be in full force, even when people will have to give gifts to their near and dear family members and friends, then also I think 9-carat will become a very important tool to give a gift item to your loved one. So that's how I'm looking at it. So, but if you ask me that is it a positive thing response, I will say yes. The initial responses are positive.
Okay. And one question related to this, sir. How do you see the organized jewelry sector's market share changing over the next 2-3 years due to this 9-carat hallmarking becoming mandatory?
So I think the organized sector is in a growth trajectory, and is as we look at it, what we have seen in the last 10 years, that the organized sector is having a growing at a higher rate and capturing more market share. I think whether it's 9-carat, it just opens up the opportunity for, I think, the industry to provide jewelry, and especially so the studded jewelry within the budget of the consumer. And just like diamond jewelry, even lab-grown diamonds, gemstones, these all will become together along with this 9-carat, 14-carat will become a product for the consumers to buy. And the margins also will be strong for the companies also. So I think it will help the organized players to grow. And anyway, I think unorganized players they're finding it difficult to survive in an unorganized manner, and they are also getting either organized or getting out of the system. So that's how we are looking at it.
Okay, sir. And one last question, sir. Out of the planned 20 stores, we have already opened around 10. till Q1. So, what would be the trigger for you to consider increasing the total store opening target for this year?
No, so I will still, as of now, will continue to guide all of you with 20 stores, and when we are closer to the number 20, then we can review on the guidance. But as of now, we will keep guiding on 20 stores.
All right, sir. Thank you, all. Thank you, sir.
Thank you. The next question is from the line of Mithun Jain from Mod PMS. Please go ahead.
Thank you for the opportunity. Am I audible?
Yes, sir.
Yes.
Yeah. So my first question is...
I could not get your name. Sorry, I could not
my
get
name
your
is
name
Mithun.
and name, please.
My name is Mithun James. I represent Mod PMS.
Okay, thank you.
Yeah. So my first question is more of a slightly a strategic long-term question. So what do you think is your right to win in this market against the likes of the bigger competitors like, say, Kalyan or Titan? The reason why I'm asking this question is, if I understand it right, our story is a story of premiumization of maybe advantages of Eastern India category. And when your competitors are sort of planning for starting 70, 80 stores this year, we are still having a moderate plan of about 20 store additions. Despite we having a very good same store growth rate of about 19%. And you are not very aptly represented in the southern part of India, which has got about 40% of the entire gold consumption pan India. So that is where I'm coming from. So can you please respond to that?
Yes. So see, our focus has been more of Eastern India and Northern India. Our competitors from southern part of the country, they have been, very strong in that part of the country, and we wouldn't want to focus there for now. We will work towards, getting deeper and deeper into the markets of Eastern and Northern India. So that is one. And the second part is that, yes, being from the eastern part of the country and closer to the manufacturing hub of Calcutta, we will try to create new designs, make lighter weight jewelry. Our competition is also working on designs, but everyone to their own. They are increasing their market share by opening more stores. We will also open our number of stores in the markets in which we are strong, focus on the low-hanging fruits so that our return on capital remains strong. And the right to win is where I think that, the market is big enough for everyone to live together. For a consumer, today's day and time, no consumer is very loyal. They are looking for new designs, they are looking for options, and I can see myself that the same consumer that is with me is with, say, 2-3 more jewelry players. So they are also trying out many types of jewelry. So I think that, as long as we can focus on fulfilling the needs of the consumer and creating the product that they need, consumers will continue to buy. And most importantly for the jewelry industry per se, the unorganized to organized shift that is happening is helping all the players, all of us together to capture more of the market. And I think that's how one has to look at it.
Okay. Right. Thanks. And my second question is regarding the operating profit margin. So this quarter we have clocked about 10%.
Sorry to interrupt.
Yeah?
So we request you to please come back in the queue for a follow-up.
This is my second question. So I'll just ask this question also.
Yeah. No, we'll give answer to you. This operating margin, as we have replied earlier.
My question was this. Regarding the operating profit margin, if you look at the trend, the last 3 years in quarter 2, it has been almost 4%, 5%. So is there some seasonality, some impact on operating profit margin in quarter 2? That's the question. Sorry, please go ahead.
No, I will answer this question. See, so we had a slightly aggression in the operating profit margin quarter on quarter, and this was a major issue in quarter 3 as well. So we have looked into our entire process, discussed on our accounting. We have discussed our hedge accounting as well, and then our quarter 4 number, we said we are confident about the reporting, Q1 also. So with this sort of aberrations which you've seen earlier, we are hopeful and confident that those aberrations will not happen. Aberrations cannot be more than 100 basis points. So because we don't reduce or increase our making charge from one quarter to other, there is no substantial change in the product mix. So one can say that, okay, in the wedding season, wedding jewelry is there. So our understanding is that the difference will not be more than 100 to max 100 basis. 100 basis point is the max variation which can happen, if at all. But for an entire year of 12 months, we will earn around 6.8 to 7.3, or maybe let's say 7.5.
Okay, thank you.
Quarterly aberrations will reduce substantially. That is the key answer.
Sure. Thanks.
Thank you.
Thank you. The next question is from the line of Shubhanu from Three Head Capital. Please go ahead.
Hello, sir, I am audible?
Yes, sir.
Hello. My first question is, how is the demand and footfall are you seeing in tier 3 and tier 4 market after this gold price go up?
So, Dhaval, would you like to answer?
Yeah. So we have seen a good traction in tier 3, tier 4 towns also. The footfalls are up. And if you see the way we are moving, we are opening more and more stores in tier 3 and tier 2 towns through the franchisee model. So business is up, the traction is good, and we are seeing a positive season ahead with the festive setting in. We are seeing Durga Puja and Diwali setting in. We are seeing a good numbers so far.
And my second question is, why your FOCO store growth is much better than FOCO? Hello?
Sorry?
Why your FOCO store growth much better than COCO store?
Why are FOCO stores grow better than COCO stores?
Yeah.
No. So if you see our numbers in like-to-like store growth, that we have, in fact, our COCO is performing better in terms of same store growth than the FOCO stores. So COCO is doing better. It's not that the COCO is not doing better. We are seeing a good traction. In fact, all the metros that we have, including the Delhi NCR, we are seeing a good 34% growth in the Delhi NCR market. So our COCO are performing very good right now. Similarly, on the the franchisee stores are also having a good same store growth of 17 to 18% right now.
See, and just add to what happens with the franchisees is that because they are in the smaller towns, they are being able to manage with lower inventories. But in the bigger cities where our COCO stores are, because of competition and consumer choice, we need to keep more inventory and more important. So that's where the franchisees also with a more lower level of inventory can manage to perform better. That is also one more part to it.
Okay, understood. Thank you.
Thank you. The next question is from the line of Bhavya Gandhi from Dalal and Barucha Stock Broking. Please go ahead.
Yeah, hi. Thanks for the follow-up. So just wanted to understand your view because we are slightly comparatively weak in terms of liquidity because you said just to manage hedging and liquidity, we are doing lesser hedging ratio. So why not focus fully on FOCO stores and improve the liquidity position and the ROC matrix? And that is what Kalyan did, and we can see how they've been expanding. So just wanted your view, sir, on this.
We are really conscious of the fact. And that is why our expansion and our strategy to the team is that most of the expansion should be with the focus on opening more franchisees and the offerings and the commission incentives that we are giving to the franchisee. We are also continuously working on that so that we can make it more easy for the franchisee to open more stores. So we are very much conscious of the fact that you're saying, and we are trying to strategize accordingly and do that. So that once that happens in a very good way and a faster way, as you rightly said, that the liquidity challenges will not be there. So hopefully in the coming year, next 2-3 years, our franchisee numbers will also be higher.
So, just a follow-up on this. So, can we expect like the further store openings would be more on the franchisee side? If you can just guide for maybe FY27 store openings and what is our future plan beyond FY26, that would be really helpful.
So see, I'll tell you, all as per the plans, we always believe in giving you a conservative, estimate and an approach. And so from that perspective, we have always said that we want to open 18 to 20 stores every year after year, funded by the profits, funded by the equivalent amount of debt that we have. But yes, like we always say, 50-50 franchisee and 50% franchisee and 50% own store. But our internal efforts are always that 50-50 can become 65-70% franchisee and 25-30% own store. So this is how we would like to do it in an ideal case.
So, just wanted to understand, is there any hurdle in terms of opening franchisees or getting franchisee partners on board? That is why the ratio seems to be slightly lower, or is it our choice that we are opening balance of both COCO as well as FOCO?
So there are 2-3 things. One is that, in East India, North India is our focus. So as a brand, as we are expanding nationally, obviously people across the various markets, across the towns and cities. So we want to grow in a concentrated manner, focusing on East India first, and the second priority is North India. So I guess that it is about finding the right partner and getting the right market, the right location. Those are certain critical aspects, and even after finding the right partner, that partner needs to have the adequate capital to open a franchisee store. So the banking is one. So there are various methods to it. So getting the right partner with the adequate capital is one of the key factors, and then satisfying his needs and getting the right product in place. So that is what it is. So I think the hurdle is about getting the right kind of people. And once that effort that we are putting is going on, we will be able to achieve what we will be able to achieve. And I know that you're comparing with the others, other competitors and the way they have been able to execute and have been able to grow at a faster rate. So I think that it's a matter of time, as and when our performance and our awareness will continue to grow, we'll also be able to do the same manner in the coming 2-3 years.
Fair enough. So just one last thing, if I can squeeze in. On the Mellora front, if you can provide some light, are we going to require any capital? What is the outlook there over there on the Mellora front? From my end.
With the 9 carat hallmarking, 14 carat, with the gold prices going up so high, we feel that, to cater to the new generation, it is going to be an important tool and a method to reach out to the new generation customer. So that is where, from a brand perspective, we are looking at doing this collaboration. And when it comes to, acquiring Mellora as a brand, most of it, the inventory part of it is not going to be a challenge at all, because anyway, there is more than enough inventory that we have with us, be it gold or diamond. It is all about getting a platform to reach out to the new generation customer. So I don't see much of a challenge. We are, in the negotiation stage, and as and when the, any kind of positive news come out, we will be updating our investors and the analysts.
Sure, sir. Thank you so much. I really appreciate it. Yeah, that's it from my end. Thank you.
Thank you. The next question is from the line of Himanshu Shivhare from MB Investments. Please go ahead.
Yes. Hi. Good afternoon. My question is, what is the company's philosophy in terms of corporate governance? Does the company aspire to be in terms of corporate governance in the leagues of your peers like Tanishq? And if you could give me, what is the company doing in terms of related party transactions, in terms of independent directors, in terms of transparency, to increase transparency among shareholders. And my second question is if you could give me an insight on, what percentage of your jewelry is generally hedged gold and how is it managed by the company, and what is the overall company's philosophy in terms of managing the inventory in conjunction with the demand supply dynamics? Thank you. That's from my side.
Thank you for the question. So, Pankaj, you take it. I'll just say that in terms of the market, we have a lot of respect for the Tatas and the Titan as a company with which, how they are running their business. And, Mr. Ratan Tata is one of my role models, and I would like to, follow his path and take my company forward. So that is how I would like to look at it, and we will be, we are doing our best in terms of various initiatives of corporate governance and the best practices. I'll request Mr. Banka to, explain a few things that we are doing.
Sir, building on what you've said, since and in this journey of corporate governance in Senco, while I joined 5 years back, I see this journey for more than 20 years. And while the first private equity funding happened in the company in 2014, the company, the promoters, our founder chairman, late Shankar Sen, had the vision to take the company to the highest level of corporate governance. And the journey started with appointing independent directors, appointing KPMG as the statutory auditor. KPMG completed 2 terms of 5+5, and then we appointed Grant Thornton, that is Walker Chandiok, as our statutory auditor. The investors can look at our independent directors. It's a board-governed company, very reputed independent directors who've got excellent experience in their respective field. Mr. Bhaskar Sen, he is the chairman of United Bank of India. Mr. Sankar Haldar, he has been working with the top company as CFO. Mr. Kumar Sankar Datta, Mr. Suman Verma. So that is one. We have a strong set of rules and regulations, LODR policy, very strong governance focus as far as the IFC form framework, risk control matrix, risk register, internal controls. The total organization is driven by ERP. We are one of the top customers of Microsoft ERP in India. Our entire organization, most of our activity runs on Microsoft ERP, workflows-driven approvals. And in most of our audit committee meetings, we consistently work at enhancing. And sir, as you rightly said, I am also an admirer of Tata Group, and I've worked in the Tata Group company for 3 years. So whatever I've learned, we intend to implement all these corporate governance practices. And Senco, this is the hallmark of our commitment for transparency, for speed, and for governance level. That is a larger answer. The second question was on the hedging practices. We have issued a detailed document in Q3 on our hedging practices, and we continue to follow the same rules and norms. So our board policy talks about the minimum 50% hedging of inventory. So if you look at our inventory in the balance sheet at around 3,500 crore, the gold inventory will be around, let's say, 3,000 crore or 900 crore. 50% of that is always hedged. Last year, that number ranged up to even 95%, or average was almost 88%, which you said in Q1 is between 60 to 65%. And hedging is a very dynamic activity. We are cognizant of the risk which is inherent in the business, and we will follow a very dynamic policy to ensure that we are risk mitigated. First quarter, due to the extreme volatility and due to the working capital requirement, we have maintained a slightly lower hedging ratio, but yes, and that has moved to the P&L. And that's why we are still giving guidance of 6.8 to 7.3, which automatically means and assumes that hedging can go above 80 as well. I hope that this answers the questions.
Just a follow-up question. Like, at the moment, what is the hedging, percentage? If you could give me a tentative figure, that'd be nice.
No, I don't want to give you a specific number. See, it should be around 60 to 65%.
All right. Thank you so much.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference to management for closing comments.
Thank you very much. I would like to thank all of you for joining the call, listening to all of us, and I hope that we have been able to answer as much as possible the queries that you have. Mr. Banka and our team is always available to answer any more of your queries. You will all get the updates on our website in terms of the numbers. One is that we have our official commercial website, which is sencogoldanddiamonds.com, and we also have a corporate website which is sencogold.com. So a lot of information on our company and the updates you will be getting there as well. So look forward to meeting and talking to all of you once again, and happy Independence Day in advance, and hopefully we'll have a great Q2 and a great preparation for the upcoming Q3 as well. Thank you very much.